Welcome. My name is Bella, and I'm your host for today's annual Economic Outlook webinar. Now, before we dive in, I'd like to share some important disclosures on this next slide with you. And then I'll hand it over to our presenters shortly here. This webinar is being recorded and will be made available to you on our website under the Resources tab and also posted to our YouTube channel. There are 2 poll questions on your screen. If you haven't had a chance to already, please take a moment and respond to those. We'll go over those answers at the end of our presentation. Also, at the end of the webinar, we'll be doing a Q&A session, so feel free to type your questions into the Q&A box at the bottom of your screen, and we'll get to as many questions as we have time for at the very end here. So before I hand it over to our presenters, we actually have a video we'd like to show you with some 2024 milestones.
Bitcoin hit an all-time high of over 100,000 in December. Bitcoin in the crypto space has become much more mainstream as 7 to 21% of Americans own some kind of crypto. The main reason behind the increase in Bitcoin has really been about the new administration making good on promises like no tax on crypto transactions or holding Bitcoin as part of the strategic reserve. The optimism behind crypto is betting these things will happen. Will the Bitcoin rally continue? We'll have to wait and see.
All right, hey everyone. As you can see from the chaos going around me here in the garage, my family and I are currently in the depths of moving into a new home. Definitely a little overwhelming, and I thought I'd share some interesting numbers from the 2024 real estate market. The housing market last year was nothing like we'd ever seen before. Home sales hit a 30-year low with mortgage rates hovering around 6.88% and the national median home price reaching $404,000 in September. There were 4 million home transactions in 2024, which is comparable to 1995 when the population was 22% smaller. What did improve? Inventory did. We had a 4.3 month supply, which is up from previous years. People were innovative by converting strip malls into housing, office buildings were transformed into habitable living spaces, and the YIGBY movement was born. Yes, in God's backyard, where faith-based communities built homes on their property. Throughout the year, affordability was low and the lock-in effect held strong, helping to keep inventory low. If you think interest rates are going down in 2025, I wouldn't hold my breath just yet for that. We haven't seen mortgage rates drop as the Fed cuts rates.
In 2024, Black Friday, consumers spent $10.8 billion. That's more than double in 2017. There was 4 hours of that day where people spent an average of $11.3 million per minute. That's a lot of shopping.
Amelia, don't you think that the Fed cutting interest rates was the biggest news of 2024? Yeah, it definitely was. We use interest rates to value capital assets like stocks, bonds, real estate. The Fed finally lowered interest rates for the first time since 2020. So they sent a signal to the market saying, we think that we won the fight against inflation and that we can get business back to business. They removed that restrictive policy, so to me, I think it was the biggest news of 2024, affects stock prices and so many other things that we rely upon every day within the markets.
In 2024, gold reached an all-time high at $2,777 per ounce. It's seen as a safe haven investment because it's a tangible asset, and it's a hedge against inflation. I heard Redlands was a boom town back in the
day. Did you know that NVIDIA reached $3 trillion in market cap this year? That makes them the 3rd US company to have reached that market cap. In January, they started at 1.2 trillion. By June in 2024, they were at 3 trillion. That's a 150% increase just in 5 months. And for comparison's sake, California, our GDP is 4 trillion. So that makes us the 5th largest economy in the world. NVIDIA is almost as close as we are to being that type of economy. And another comparison, the oil and gas companies of the US, Exxon, Chevron, and Shell, they only make up $2 trillion in market cap combined. It's crazy, huh?
All right. Well, as you know, my name is KWB. I'm the founder of KWB Wealth, and thanks for joining us today. Hope you enjoyed that little homemade video. Very inspiring. Thank you guys for doing that. You know, today I have with me Steve Gormley, and Steve is our Director of Portfolio Management. And we've tried to do is actually have some different viewpoints. So I am the token baby boomer. I was born in 1962. Steve is our token millennial. He was born in 1983. And again, he is our Director of Portfolio Management. And then today we have Claire Olmsted with us. She is our token Gen Zer, born in 1998. And she is one of our associate wealth managers. And she's been with us about a little over three and a half years. This summer, we'll be here for 4 years. So what we wanted to do today was kind of like talk a little bit about some of the things that we see in the news, some of the things that clients are asking us. And then what we're going to do is after we talk about that, kind of delve into a little bit of history and some of the data and the facts. You know, it's always interesting to talk about what's in the news, you know, what's hot, what's controversial. But at the end of the day, when it comes to markets, you do have to open the hood, get into the weeds and look at really what's going on. So Claire or Bella, if you'll bring up that first slide. So what's ahead in 2025? As you guys know, yesterday, if you didn't pay attention, we had an inauguration. And Donald Trump became the 47th president of the United States. He also, interestingly, was the 45th president of the United States. So I don't know, when they talk about Trump in the future, they'll say, well, number 45 or number 47. Either way, it's Trump. The one thing we know about Trump, though, is this is his last term. He will term out. And some have said this is his, you know, Trump 2.0 version. This is where he really wants to do things to protect his legacy, you know, to build on something and what he says, hopefully make America great again. And so some of the things that we know Trump is going to do, and he's doing them very quickly. And one of the things about Trump is that if you watched him in the, you know, run up to the office, as far as during the election promise or, you know, the election, what he was promising and was going to do, he's pretty much living up to that. So what we saw just yesterday is he is ending the electrical vehicle mandate. In other words, he wants to let car companies build cars that can sell, make profits, and he's no longer going to maybe incentivize people to buy a certain type of a car. He's implementing like regulatory freezes. So what he doesn't want to do is he wants to, for every new regulation that is brought forward, he wants his people, if you will, to cut 10 regulations. The whole idea is to allow companies, small and medium-sized companies, to thrive, to operate, and hopefully not spend as much time as trying to comply with regulatory issues and the things and the services and the products they deliver. He's also beginning to remove or make emergency powers to really make energy in this country more available, and so that we can ultimately be independent and not relying on any other sources of energy from maybe our foreign neighbors or whatnot. I think he uses the saying, you know, drill, baby, drill. And the last thing he's trying to do is just, you know, the whole Tax Cuts and Job Act, the TCJA. One of the things that we were concerned about is that in 2025, that TCJA would expire, and in 2026, taxes would increase. And so what he's doing is holding true to his form and likely going to do everything he can to have that extended. So less regulation basically means, you know, maybe we're going to open up the entrepreneurial spirits, the animal spirits of entrepreneurs, and so that these people can really go out and thrive and build businesses and whatnot. The next thing is tariffs. He's had a lot of bark about tariffs, and so far we've seen nothing. Even though he's only been in office maybe 24 hours, everybody thought he might do something quicker. What he has said is that maybe February the 1st, Mexico and Canada, he might implement those 25% tariffs. I kind of think he's really using the tariffs as kind of leverage to help slow down the border problem. And if you've read the news a little bit, he has been very aggressive in trying to stop and protect the borders. He's also trying to do away with the birthright citizenship. Just because you came here and you were here illegally and you had a child here, does that make it right that that person would be a U.S. citizen? And according to what I've read, we're the only country in the world that does that. So really, the tariffs are really all about realigning maybe some of the offsets, what's been happening with other countries. And the last thing is that U.S.-centric policy agenda. He said some pretty, outrageous things. Hey, I want to buy Greenland. I want to buy Canada. I want to take back the canal. And I think at the end of the day, what he's trying to do is make America great again. And I hope that he does it politely and that he doesn't become an expansionist like we saw actually in the early 1900s, even with some of the other administrations. So your guys' thoughts on that?
Yeah, the one thing going back to the TCJA is during the first iteration of it, he cut corporate tax rates from 35% down to 21%. And they're also thinking about doing another cut of that corporate tax rate from 21 down to 15. And that could boost earnings per share for US companies by about 4%. So that would be a big change, a big boost to companies and to profits. The other thing you talked about it, we could see increased mergers and acquisitions activity, M&A, and more IPOs, so new companies coming to market. So with less regulation, it just means that there's more entrepreneurial spirit and more companies could be doing more activity, which again is a big boost for corporations and for earnings.
Yeah, I agree with you on that, Steve. When you look back at the past 10 years, the private sector has just exploded because, there's just been so many regulations and handcuffs that have been put on the public sector that, it's forced these people to say, why would I go through, all that red tape, when I can do it much easier in the private sector. So I totally agree there. When I look at the tariffs, it's a negotiation tool. I think he's trying to call, these countries to the mat. He's creating the External Revenue Service, the ERS. You may have heard that in his speech yesterday. That could be a good thing. It could be, another influx of millions and millions of dollars into the economy. And I think it's trying to hold, other countries accountable and, maybe call them on the free ride they've been getting for a long time. But I also say too, things do have to get passed through Congress. It's going to take a long time before we may actually see some of, the effects of what Trump's saying. So as Kerry said, sometimes his bark may be a little bit bigger than his bite. So, we just have to kind of wait and see what actually happens.
Yeah. And so the other thing to think about as we move into a new regime, a new presidency, the last 2 years, we've had economic growth of about 3%. And we don't see really anything changing on that standpoint moving forward. The Fed is predicting that we're going to have about 2% growth in 2025, and they foresee that for the foreseeable future. So, what's driving that? Consumers. The U.S. consumer is the biggest driver of the world economy and the U.S. economy. It's about 70% of the U.S. economy. So as we continue to consume, we don't see really any recession in the future, and neither does the Fed.
Yeah, and I think Leslie in the video before talked about consumers and shopping and how much money we were spending every minute. And if the economy is growing, maybe it's not as fast as we'd like, or maybe we grow as fast as we can without inflationary pressure, there's a good likelihood that the markets are going to continue to do well. And one of the things that we see that might actually help the economy do well is the interest rates that are going on, in the economy. So, the Fed has already lowered rates, I think 3. And we originally thought maybe they would lower them as much as 6 times, by the end of next year. They haven't done that yet. And part of the thing is that the economy appears to be better than what a lot of people thought. And interest rates typically are going to be reduced if the Federal Reserve believes, the economy is slowing down. We might dip into a recession. So what we want to do is cut rates so that the economy continues to grow and prosper. Well, what we've seen in the last couple of months between inflation's been coming down, maybe not quite as fast as we want, but the economy still tends to be very strong. And just last week, we saw the jobs report. And what that did is the jobs report said, well, wait, businesses are hiring, the jobs are available. We don't want to be too quick to lower interest rates.
Yeah, I would agree with that. The Fed always makes their decisions. They're very data driven, looking at the jobs report, looking at the CPI, the consumer price index, looking at what the consumer is doing, and they make their decisions based off that. And we keep seeing positive numbers. And I think if we still continue to see that, we're going to have, rates that are, going to be stabilized at this point in time. Maybe one cut, maybe two cuts, we'll see. But I think overall, we're on a good path at this point in time.
Yeah, the thing to know is that even with two cuts this year, the short-term interest rates would only go down to about 3.75 to 4%. That does not impact longer-term rates. As we've seen, the Fed has lowered interest rates on the short end, but the 10-year rate has continued to climb, which leads into kind of mortgages and what the mortgage rate you can get is. So it's important to know that they're really only cutting short-term rates. We're not really sure what would happen on the long-term rate, even if they do cut some more.
Yeah. And it's kind of a good news, bad news, right? The good news is the economy is doing pretty well. And the good news is there's jobs and we're growing. The bad news is, well, we'd like it to be growing a little bit less so that the Fed could cut interest rates. So the good news is that we have tailwinds behind us. We don't think the Fed is going to raise rates, so that would be restrictive. If anything, they'll either pause or continue to lower rates a little bit based on, as Claire said, economic data dependency. Yes. So Claire, you're our Gen Z person here today. And I think no better person than you could tell us about AI. What is AI? What does it stand for? And what do you think?
Absolutely. I feel like I am definitely, primed to take over this for AI. So what it stands for, AI stands for artificial intelligence. And basically what it is in simple terms is teaching computers to use, human intelligence. This is, computers having data and using them to, track patterns and help make decisions and, answer questions. If you haven't ever used like ChatGPT, there's Microsoft Copilot, there's tons of, AI type generators out there at this point in time. Highly recommend using it just to see, potentially the power. If you're Carrie, you're asking questions about fishing, maybe. If you're Steve, maybe you're asking about Notre Dame last night, how they lost. I know that's sensitive, but, AI is going to be revolutionary, I think, in our economy. It helps to, essentially automate repetitive tasks. It can help, speed up processes. We're using it here at our company. A lot of businesses are investing in it. You see tons of things in the media. Microsoft, Apple, they're investing, billions of dollars into this. The biggest argument I hear from most people, or I guess the biggest fear, is, well, AI is going to replace me or they're going to replace my job. The World Economic Forum came out recently and said that, within the next 5 years, by 2030, that over 170 million new jobs globally would be created with the use of AI. In the process, it would eliminate over 90 million jobs, but that's still a net positive job report. And I think that we look back at, the 2000s, early, 90s at this point, and you had a huge tech boom. I think it's going to be, Carrie was mentioning earlier, maybe a little bit like the Industrial Revolution. I think AI is going to be a huge driver in our economy going forward, and it's something that's here to stay.
Yeah, and AI has all to do with really efficiency. If we can do more with less, that helps inflation stay low. We're using it in our meetings, even on our phone calls, where we use a thing, well, I won't say the name of it, but anyway, a translator, transcriber that will take our conversations and then consolidate it into short notes and key takeaways so that Carrie at 10 or 15 words a minute doesn't have to type it anymore, and we can actually log the call and whatnot. So a big time saver, for us. And yeah, you look back at the great industrial revolution, the invention of the trains and the automobile, the assembly line, and you go further and you look at the 1990s with the technology and the internet and the computers and what Microsoft wanted to do with a computer on everybody's home and desk. This AI thing is big, and I think it's really going to help us grow our economy while keeping maybe inflationary pressures at lower levels.
I think another point too is that, it's able to analyze a large amount of data in a very quick setting. And so it's able to give us a lot of accurate data and help us to kind of understand, what's the market doing, where are we headed? And it can kind of help us, give a little bit more accurate insight and look at, vast amounts of data in a quicker way.
Yeah. And for those that, watched the video, Rachel there was talking about NVIDIA, saying it was $3 trillion, almost as big as California. Well, and NVIDIA is one of the key companies that have really benefited from AI and having the chips and whatnot to make all that happen. So we got AI, but the other thing we're concerned about sometimes, and I hear in the news, Steve, is high deficits. How do we keep spending so much money, and when do we need to be worried about all the debt that we're taking on?
Right. So let's put a few numbers behind, deficit and debt. So the current deficit projected for 2025 is $1.9 trillion, and that makes up about 28% of the federal budget. The total US debt currently is $36.3 trillion. And so, what these numbers mean or what they could lead to is higher interest costs. As the national debt grows, so do interest payments. And with higher debt levels, more of the federal budget has to be allocated to paying interest rather than funding essential services like infrastructure or education or healthcare. So, this can really limit the government's ability to invest in areas that drive economic growth. The other thing is everything that we've ever heard. I've been in this industry 20 years. Carrie, you've been in since 1987. I have heard the potential for higher taxes or the potential for higher interest rates for years and years and years because of the debt. And it just hasn't come to the surface. I think eventually it will happen. There will probably be higher taxes eventually, but to know when that will happen is virtually impossible. So the best thing to do is just stay diversified. We are definitely worried about that, but in the long run, we just don't know when the debt bear will come to roost, kind of a thing.
Probably in my generation. We'll have to pay the piper at some point.
Right. Well, keep working and pay our Social Security in the meantime. Yeah, I remember being in the Air Force in 1983, and Reagan was, I think, Bush were just, they were in the office. We were fighting the Cold War. The Cold War was where we were spending oodles and oodles of money to try to bring the Russians to their knees, and we would outspend them. And the big thing at the time was, how can we possibly pay for all this? So that was, like Steve said, about 40 years ago, and we're still talking about the same thing. Yeah. So we got the deficits, we have the cumulative debt. Certainly, the bond vigilantes might hold the Federal Reserve more accountable at some time. I think at this point in time, when you look at all the economies out there, we're still probably the best house in, at least this neighborhood. So the other thing that's been going on is we have a strong dollar. And for those of you who know, I like to travel to Canada and Mexico and other places. And one of the things that I see today is, probably in 2008 or 9, the Canadian dollar was actually stronger than the US dollar. A lot of Canadians were coming down and taking advantage of the housing market here in the United States, buying places in Palm Springs. Today, though, the Canadian dollar has had a major reversal over the last 14 years or whatever, and now it's about 70 cents on the dollar. So for Americans that want to go north and maybe take vacations, what you're going to find is you're going to go up there and you're going to be able to have dinner at about 30-40% off normal prices. Same thing's happening in Mexico. It used to be it would take 12 pesos to buy a dollar. Now it takes 20. So one of the things that's happening is that strong dollar, and us being the reserve currency, has helped us buy products and services from other countries at cheaper prices, which has helped us keep a lid on inflation. It's a little more difficult, though, when you look at the strong dollar and maybe you look at tariffs, as we talked about, even Canada and Mexico, the strong dollar makes the products that we buy from Mexico very cheap. So if you start putting tariffs in, maybe it just brings it back to parity. I don't know that we'll see that. Again, I think it's more about getting the border in control and really putting, both Canada and Mexico, with some might that maybe will change things.
Yeah. I mean, there's always two sides to the dollar coin. On one side, since we're an import economy, it helps when we're importing goods, but it also does hurt when we export. So 40% of S&P 500 revenues come from outside of the U.S. So a strong dollar does hurt that revenue portion. So it's one of those things that a strong dollar, weak dollar, there's goods and bads to either side of that, that coin.
to kind of continue on that, one of the good things is that, when you look abroad, you look at Japan, you look at Europe, even China, they've had their own monetary issues and they've had their own, interest rate, hikes and things like that. And so, the US has become a good safe haven for money at this point in time. Lots of geopolitical issues, especially Russia and Ukraine. People don't like those types of things. And they like to say, I want to keep my money somewhere safe. And the US is a great place to do that. So you've seen lots of money coming into, the Treasury. And I think that'll be something that's probably going to be pretty consistent going forward. The dollar is always going to be, the best foundation, probably looking at currencies. Every currency is relative to the dollar. So I think that is something that the US has in its favor.
Yeah, for sure. All right. So the next one we want to talk is a little bit about the housing market. I'm not looking for a house, but Claire, I hear that maybe one of these days you might. Tell us your thoughts on the housing market and as you contemplate, purchasing a house in the future. And I do want to say one more thing. I've always said, so goes housing, so goes the economy. So give us your thoughts.
Yeah, hopefully there's some hope out there, for some of the younger people. If you're parents of young people, you probably feel a little bit of that pain even for your child as well. It's tough. I'm not going to lie. Part of it is that, right now you have high borrowing costs, interest rates being high, also with prices being high, it makes it a little bit tough for us. So part of it is, do you wait on the sideline? Do you wait for rates to come down? There's always, you can always refi, but, it is tough when you look 2 years ago and rates were, 4% versus 6%. It makes a drastic difference. And so I think that you do have a lot of younger people on the sideline just waiting, for potentially rates to come down and just a little bit of a better economic environment to kind of, jump into that part. The other side of this equation with the housing market is that right now, most people that have homes, they're locked in at 2, 3, 4%. And they're not wanting to go out and get a different loan at this point in time. They're not wanting to go out and get a 6%. So they're wanting to keep the rate that they have. That kind of affects supply a little bit. So that can make it a little bit tough. It's a little bit more competitive in that landscape when you do find, a home that you may want. But I think going forward, you just have to wait for your right time. The other part, especially if you do live in California, you got to factor in insurance and property taxes. That's been the biggest, thing that I've seen amongst my friends, amongst myself, is that, it's not just, what the loan you're going to get and the payment. You have to impound it and you have to look at what those insurance costs are and the property taxes. An example, recently I had a friend, she got like a $3,000 mortgage payment, and then you add in the property tax and insurance and it's an additional $2,000. Her payment's now $5,000. That's pretty significant increase. And so that's something I think that's been a little bit of tough, especially for people in California. Wow, this is something that I have to kind of account for. And it's tough. I'm not going to lie, but I think that there is hope. I think sometimes you just have to wait for maybe that time in the future and just, be ready when the time comes.
Yeah, the big thing to me is that I don't think housing itself will pull the economy into a recession because there's that underlying demand. I think lots of people my age and Claire's age are out there wanting to buy a house. They just can't at this point. There's just not enough
supply. The demand's there.
Yeah, the demand is there. The supply is not. So that's something hopefully that the Trump administration can work on, is getting more supply into the market. The other thing I think about when you're buying a house is how much economic activity that drives. So, when I bought a house, we had to get new furniture. We had to get, multiple tables for different rooms. We had to get beds for every room and all of these different things. So buying a house and owning a home is a significant driver of economic activity over time. So I have some friends in the mortgage industry, and they're saying that what they're hearing is that when we get below 6 on mortgage rates, that's when you can see a lot of movement between people who are now willing to sell because they need a bigger home, or are willing to buy because they've been waiting for so long. And
we joke too, I feel like everyone's always a Home Depot in this office. Being a homeowner has its own responsibilities that sometimes I think this younger generation may not be quite ready for at this time.
Yeah, and that flows into the next topic, which is inflation. So housing is the largest component of the inflation measure that the Fed looks at when they're deciding what to do with interest rates. And so because we have that supply-demand imbalance, we probably won't see a big move either way in home prices. And so that should keep a lid on inflation as we move forward. The second largest component of inflation is oil prices. And so as Carrie's point earlier in the talk, drill baby drill, that should keep a lid on oil prices as well. So the two largest components of inflation are probably not going anywhere higher. And so that should lead us to, not having to worry, or the Fed not having to worry about the inflation side of the coin. And they can really focus on employment and driving more people to have more jobs, which drives economic activity.
Yeah. And this whole housing thing and inflation, I think housing, and maybe with the impact of some deregulation, just like in California, after all the fires the governor is talking about, or maybe they're already enacting measures where we can make rebuilding a little quicker, where we can stop some of the things that used to take months or cost lots of money to figure out the impacts on the environment and allow these houses to start. And I think you're going to see some of that probably nationwide. So we kind of talked about all the things that we kind of see in the local news and hear in the local media, and maybe even see as you discuss with your friends. But let's take a deeper dive now into history. So let's go to that next slide. And let's look at some of the data points. And now we're not going to talk as much about, well, who's in office, Republican, Democrats, whether it's Trump or Biden or whatnot. And I think this is really compelling, these data points that we're going to talk about. So this particular chart here goes all the way back to 1928. So that's almost 100 years. It's 98 years of history, right there at the Great Depression in 1929. And what you see there is that when the market is positive, on average, it's up 21% when it's positive. When the market is negative and we have a tough year, on average, it's down 13%. So if the market's positive in 2025, on average, it would be up about 21%. Now, Steve talked about earnings and growth and earnings per share, and maybe we would see 15%. But what is compelling is, look, if we're positive, we have an average pretty nice return. The next chart shows a little bit about, well, how many years is the market positive versus negative? So what this chart shows is, in the pink or the red, whatever color you want to call it, those are the years that the market either made nothing or less. So in other words, in 1931, you'll see the market was down even as much as 41% or 40%. And what this is basically telling us is that on average, the market is positive 73% of the time. So every year you wake up, there's a 73% chance the market's going to be positive. And every year the market's positive, on average, it's done about 21%. I think what that chart showed was that actually the market had averaged about 9.8% since the Great Recession. So when you look at just data points and forget about what politician, what party is in power, and you just look at the facts, there's a pretty good reason to be optimistic.
Yeah. Bella, if you could bring up the next slide, the reason to be optimistic is because of earnings. So one thing that I hear way too often is that investing is like gambling. And this might be true over very short time frames, but as you can see, over the long run, the market does about 9.8%. So higher stock prices are actually driven by three components. It's earnings growth, dividends, and multiple expansion. And so since 1950, the key drivers of growth have been earnings and dividends, not really people paying higher prices, although that has helped. So multiple expansion means what people are willing to pay for stocks. So 60% of market gains over the past 75 years have been because of earnings. So one thing that we know moving into 2025 is that dividend yields on stocks are going to be about 1.2 or 1.3%. And we also have estimates of earnings for the next 2 years. So Bella, if you could bring up the next chart, it shows that it's expected that earnings will grow about 14% in 2025 and 13% in 2026. And that's without even if he does anything with if Trump does anything with the TCJA and we have another, corporate tax cut, that could boost those earnings as well. So these numbers can change, but if market participants don't feel any better or any worse, meaning there is no change in multiples, what people are willing to pay for stocks, then we could see a pretty good stock increase in 2025, maybe 10 to 15%. However, we don't know what market participants are going to do in any given year, so it's really impossible to know what returns will be. But it's always best to look to earnings as the guidepost and not headlines or market prognostications from market gurus or anything like that. And earnings are what's going to really drive the market as we move forward.
Yeah, that's a great kind of segue into the next slide, Bella. Earnings create a fantastic foundation for, what we call a bull market. If you haven't heard in the news, or maybe if you opened up your statements, hopefully you've seen it up and it's been going up for, about the last 2 years, that's called a bull market. So before we kind of look into this chart, it's important to define what is a bull market and what's a bear market. A bull market, it comes from, when a bull attacks, it has its horns and it kind of starts low and then it slopes up. That represents the market and it's going up. And if we put it in a numbers format, that's 20% up from the bottom is what represents a bull market. We are currently in that. We started that October 12th of 2022. That may have been a tough time for some of you if you look back and looked at your account at that point in time, a big dip at that point, but we've had a lot of growth since then. Now on the flip side, we have the bear market. When a bear attacks, it raises its paw up with its claws and it swipes down. That represents the market going down, and exactly the opposite, 20% down from the top. So now that we kind of have that definition, if we look at, our bear market or our bull market that we're in today, we're in that 3-year cycle. We just hit that 3-year mark, and we want to look at what is this bull market compared to, past bull markets, and what can kind of history tell us, about what we can expect going forward. If you look at the column on the left-hand side, the bear market bottom, this is going to be the date that the bear market ended and that the bull market started. The second column, the bull market peak, this will be, the peak of the bull market, and then the next day you would have seen a significant market decline. Of course, we haven't seen that yet, so you'll see down there at the bottom, it's representing our current bull market. At the time when we ran this chart, it was back in September, but we are still in that current cycle today. Most importantly, looking at those, 2 middle columns, you'll see the S&P 500 change. This represents the return of the S&P 500 during the bull market cycle. We'll look at this and we'll compare it to what we're currently at today, and it's pretty insightful as to kind of what we can expect going forward, at least hopefully expect going forward. And then we have our years. This is going to be the duration or the length of time that bull market lasted. You've had a few outliers in there. You've had times when, a bull market has lasted even more than a decade. As I said, we're currently in that 3-year cycle. If we average out this data since 1950 of all these bull markets, the average bull market's about 5.5 years. So this tells us that we could still be very early in the cycle of our bull market. There's still a lot of time left. And then on the other point, the average return of a bull market cycle is about 180%. We're currently at 66%. So, we still think that there's a lot of time potentially left in this bull market. Some have lasted even, longer than decades. So that could be a, potential thing. But then also that there's still a lot of growth left to capture, going forward. And so hopefully we see that in 2025. But I think that's pretty good, when we're looking at history of the bull markets. Moving on to our next slide, while we've been very optimistic, we have a lot of excitement coming into 2025 and what we're expecting, but it doesn't mean that volatility is not part of the equation. It's always part of it. When I was doing my research for, this webinar, I came across a story about Warren Buffett back in 2008, and someone came up to him and said, Mr. Buffett, he's a, longtime legendary investor for those that don't know, and said, what, you lost $10 million today? And he said, no, I didn't. I didn't sell out. So the importance of this chart is to tell you that, over time, you're going to see dips in the market, but if you stay invested over the long term, you'll end up being okay. If we kind of look at this, you'll see the gray bars. Those are representing calendar year returns dating back to 1980. You'll see in 2024, the market ended up about 23%. You'll look back to around 2008, the market ended down about 38%. Over the last 45 years, if you look at these gray bars, most are up. 34 out of those 45 ended up positive. That's 75% of the time. We have a saying in the office that sometimes the stock market can be kind of like California weather. It's sunny and shiny, clear skies most of the time, but you still have your rainy days in the process. And so you have to prepare for those, and you have to understand that that's completely normal. If we look at those red dots, those represent the intra-year decline in a given year. So that would be the lowest point that the market dropped in a year. You look back to 2022, you'll see the market ended at 19, but it dropped 25. 2008, the market, was down 49%. But the key thing is when we look at this data and we average it out, if you stayed invested over the long term, you would have annualized a return of 10.6%. However, you still had to suffer a 14.1% decline in a given year to get that 10.6%. What this tells us is, when the market does go down, understand that volatility is completely normal. 2024, we only had an 8% pullback. We were a little bit spoiled, so just understand that going into 2025, if you do see your account decline, if you do see those pullbacks, understand that's part of the cycle. And the other part I'll mention is that markets are resilient. If you look back kind of at that chart, we don't have to pull it up again, Bella, but in 2022, we had that big dip. 2022 was a rough time, but the next 2 years we ended up 24 and 23%. So if you stayed invested, your account would have recovered, and just understand that over the long term, if you're a long-term investor, that you'll be completely okay and that the market will recover.
Yeah, and so looking at that chart, you can see the last 2 years have been really good. And I heard a podcast recently from a company called Data Trek, and they said that if it doubles, it's a bubble. And so what they're talking about there, and Bella, if you bring up the next chart, what they're talking about is that over a 3-year cycle, a 3-year period, that if the market goes up 100% or a double in a 3-year period, that it has led to subpar returns when you look forward. So this chart shows rolling 3-year returns going back to the 1970s. And as you can see, as you reach that kind of green dotted line at the top, that's the double, then you have subpar returns moving forward. The only time we didn't see that was in the post-Great Financial Crisis, as the market continued its run off the massive bounce that it had from the bottom in 2009. And so the average 3-year return over this time frame has been about 29%. And after 2 stellar years in the market, you may be thinking that we should be close to that bubble today. Well, we're not, because we had 2022. So the S&P is up about 25% over the last 3 years. But because 2022 is going to start rolling off of those numbers this year, that number is going to continue to grow as we move through 2025. So right now, as Claire said, if we just had no return from now until October 12th, we would have a 3-year total return of about 66%. So we're going to continue to monitor this as we move through the year. And if we get another good year, we could be running into that bubble territory. But as of right now, we don't really have that concern that the incredible returns of the last 2 years make us worried that we're in a bubble currently.
Yeah, so over the last, 30, 40 minutes, we've been talking a lot about markets and earnings. So the next chart really paints a pretty good picture for the United States. And what basically it shows on the left side of your chart is the earnings growth of companies globally around the world. And the 3 lines at the very bottom of your chart represent Japan, the Europe, ex-UK, and emerging markets. And you'll see since about 2005, so that's about 18 years, earnings have only done about a double. They're up about 100% from that point in time. Then you look at the green line that goes through the middle of the graph all the way up to the top, and that's basically the U.S. global earnings of companies. And what you'll see is that they've gone up almost 3.5 times. And so when you compare earnings to other countries, and even China is the very top line, where it peaked in 2018, and then you'll see that decline coming down. The earnings of Chinese companies have been on a decline. So when we think of opportunities, sometimes we think, wow, how can the US still be the best place? It's so expensive compared to other places. And that's true. And so that's what you see on the right side of that chart. And you'll see the first column there, the gray, it shows the 19.5 and 21.5. What that shows is what investors are willing to pay for these earnings. And the purple bar across says, on average, Americans are willing to pay about 16.8 times earnings. But now we're paying 21.5 times future earnings. And the reason is because investors see earnings growing and they're willing to pay up for that. When you look at other countries, the first one there is Japan. You'll see Japan is currently trading under its typical valuation. Part of the problem is they have a demographic problem. They're not growing. Their earnings aren't increasing like in America. You'll see the Europe and emerging markets and then China on the far right. So one of the things that has been a little bit of interesting to us is, well, Carrie, why do we invest in America? Why don't we put more overseas? That's where the value is. Well, the value is there because something else is going on and their earnings aren't growing. Now, one of these days, these countries might get this turned around. It could be, the entrepreneurial spirit that is lacking over there. It could be the governmental regulations, but we continue to be pretty optimistic about what we see in America And it's really about the earnings of corporate America and what they're doing to outcompete the rest of the world. And I think that's right down Trump's alley, is how do we make America and keep America, great again. So we've shown you some slides about history and why we're optimistic. We're going to go to the last two here and kind of just do what's our outlook? Well, first off, we remain optimistic about 2025. Steve talked about earnings being up about 14%. We talked about, if the market is positive, there's a good chance, maybe we'll see the average return of 21%. We've got the Federal Reserve actually in our court. They're not raising rates. They might not be lowering them as much as we thought, but they're not raising rates, and that gives us some great tailwinds. We don't see any negative tax changes on the horizon. Before we did, we didn't know what was going to happen with the TCJA come 2026. But with the current administration, it appears they're going to do everything they can to continue those tax rates and potentially even lower corporate tax rates, which again helps those earnings per share. And then with Claire, what she said about the AI revolution, it's big. It really is big, just as we use it here in our office, the efficiencies. I just don't see a recession around the corner at this point in time. And then we'll wrap it up with some of the key takeaways.
Yeah. So first, keep the news media in perspective. News media, their job is to get eyeballs on their posts or their television program, whatever it is. So they are not looking out for you. They're looking out for them. So always keep news media in perspective and don't follow what anybody is kind of saying there. Always give us a call when you have questions. And then look toward the fundamentals. The big one for me is earnings. Back to Carrie's point, what's driving this bull market? It's earnings. Companies in the US are dynamic. They're great at growing those earnings over time. And so that's what you are really focusing on for the long term. If you have earnings, if we have great companies that are growing, then we should see good markets in the future.
Yeah, and I'll wrap up with kind of the last two key takeaways. We've seen a lot of market growth. I said maybe when you open your statement, you love seeing that bigger number, but just make sure that you have a consistent strategy. Don't get caught up in the market growth. Understand. Don't get caught up in chasing short-term gains and taking on excessive risk or unnecessary risk that you didn't do before. Stay stagnant to what your strategy was. As Steve said before, focus on the fundamentals, and then that last point is about consistent investment through the ups, through the downs. As long as you're consistent, there's opportunities in both those cycles of that upside and downside. So, the key to building long-term wealth is, consistently investing over time, and it's a long-term game, not a short-term game. And so, regardless of what happens in the markets, hopefully it's positive. As we said, we're optimistic. The fundamentals remain the same of it's a long-term game. So I think now we're going to go back to our poll questions review. And then in the meantime, while we review those, please type your questions in the Q&A box below, and we can kind of use our last 10 minutes or so to try to answer as many as we can.
Yep. All right. So which category will make up the largest percentage of government spending in 2025? And interestingly, we weren't expecting this, but most people got it right. Interest on government debt is going to be about, I think it was 15%, and all of these other things are pretty close to that, but they are lower. So the interest on the debt is going to be the largest component, one of the largest components of government spending in 2025. And then what are you most concerned about in the coming year? Ongoing inflation. I think we tackled that one and kind of said, at least from the housing and oil standpoint, you won't see that. Now there will be, I think, things that people see. I know I was in the supermarket a few weeks ago, eggs. Yeah. This lady wasn't going to buy eggs because they were $10 a carton. And I was like, I think you still need eggs. But, it's one of those things where I think you will see those types of things. You'll see very individual components of things that seem like inflation, but the overall picture is going to be pretty good.
I think that was due to the bird flu, right? Where they had to kill a lot of chickens. Yeah.
I like the last one. One person, no worries. I love that. Whoever that person is, thumbs up.
Good vibes going into 2025 for you. Yeah.
So the first question in the Q&A box was, what are the chances of the TCJA to be extended, and will this be effective for 2026? So I would say chances are pretty good. It's definitely more than 50-50. They're definitely going to tackle this in the oncoming year. They might have to. It really comes down to what concessions they're willing to give, because they might need some Democrats to say yes to extension of the policy. But I think in my mind, that's going to be the major push over the next year. How can we extend these tax cuts?
Yeah, I certainly agree.
Yeah, and then the next question: what is your thinking about equity to bond ratio for investment? That is an individual question. That's something you should talk about with your advisor, because each situation is going to be different. So you got to go back to your plan. What does your plan say? What does the plan say you need? So, if you look at your plan and say, look, if I'm falling behind, I might need to raise my equity exposure. But if it's looking good, then maybe we can lower it as we move forward. But that's a question more, I think, for Claire and Carrie. What do you kind of think? I know it's individual between each person, but like, what are you looking at to say, hey, I think you should be, 60-40 or 80-20 or something like that?
I can go first. My take is I don't necessarily, as Steve said, the equity to bond ratio is going to depend really, on you, and it's going to be different for everybody. But at least on the equity side, we have strong earnings, and so that's always going to be a really good sign as far as equity growth. On the bond side, if you've looked at your statements, or maybe you've dissected the return of your portfolio, bonds have been hit hard the past 2 years, and so I think with lowering interest rates potentially, that could help a little bit on the bond appreciation side, so you could get a little bit better return, I think, there. It just depends. But as far as the ratio, I can't necessarily answer that question. But I do think that there's hopefully a little bit more upside on the bonds. And then I feel really great, about equities. Just we have fantastic earnings. We've gone through this kind of whole slide of we have really strong fundamentals. Companies are making money, people are spending. And I think if we continue to see that equities are going to continue to keep growing.
Yeah, and I would just say a lot of it depends on your ability to tolerate volatility.
Agreed.
And the other thing is what's the time frame for the money? So you could be 80 years old and you have Roth IRAs, and we would probably advocate, well, hey, you're 80, but the reason you have Roth IRAs is you're probably not going to be using the money, and it's ultimately maybe for your family or generations to come. So then be very aggressive. With other funds, we might say, no, you need to be more conservative because you don't have the life expectancy that you had when you were 30 or 40. So it really kind of depends on your tolerance for volatility, what the funds are invested for, the intended use, time, date. Those things would make up that decision.
Next question: with the continued growth of AI, won't the domestic job market be impacted? Claire kind of hit on this. Could you repeat those numbers that you saw?
Absolutely. So, the World Economic Forum came out and said, and I don't have domestic numbers, but they said this is a global number. They said over the next 5 years between, 2025 and 2030, that over 170 million new jobs would be created with the use of AI. It did say in the process of that, over 90 million jobs would be cut essentially out of the marketplace, but that net number is still positive. So that I will say that is a very valid question. That's kind of what I was mentioning earlier, is a lot of people ask about that. I think you will see, shifts potentially. It'll change a lot depending on the sector. And I think AI, we're still really early in the cycle. I don't know if we know the full effects of what AI is capable of and what, we're going to be using it for, but these big companies are spending billions of dollars in investments. We're spending money in investments of AI. We're trying to kind of, it's awesome. So I do think that on the domestic side, it'll help efficiency. I don't think that it will have a negative impact on the job market. I do think it will impact it, but not a negative effect.
Yeah, I think about the internet bubble, or think about that buildup. Everyone was saying the exact same thing. There's not gonna be as many jobs because we're gonna be using the internet to do some of these jobs. And look at where we are today. We have more jobs. Now, it might have affected certain people, certain industries, but the overall economy and job market grew because of it.
Yeah. Well, over history, we've seen all that, right? What electricity did to the candle maker, what the auto did to the horse and buggy and the whip maker, and so on and so forth.
You're really going back.
Yeah. But
It's
the
true. It
benefits,
happens every time.
It
Anytime we have
happens,
a
right,
revolution,
for sure.
these things,
Yeah.
this is what happens. You,
Yeah.
you worry about it, but it really comes down to what industry you're in
Yeah.
and what you're doing.
100%.
So what do you think of long-term corporate bonds? So she's thinking maybe 10 years or longer. The best indicator of what bond returns are going to be in the future is what the rate is today. So
Yeah.
if you have a 10-year bond, even if it's a government bond right now, it's paying 4.8. Corporate bonds are probably a little bit higher than that. You can expect to get that return over time. There will be fluctuations in the meantime, and knowing where interest rates are going to go is very difficult. But I would say that's your outlook. Your outlook is, this is what I'm paying today. This is the rate I'm getting. Here's what my return is going to be over time.
Yeah, and even though you said that return, Steve, I think the 10 years actually been declining again. I think it's back down around 4.6 or 4.7.
Okay.
But if you're getting 4.7, let's just say, and inflation's at 3, right? What are you really getting?
Yeah.
Your real return is only 1.7.
Yeah.
So bonds, while they offer really probably a more stable return, less volatility, but they don't really offer the return, right, over time. So.
Yeah. And then the last question is the impact of the recent and maybe future fires on the California economy. Always hard to know. I think this is the first, at least in one of the first in Southern California, that really affected a lot of homes. Typically it's more of a forest fire or a brush fire. I know we've had those in Northern California before that have impacted communities. I've reach out to the people that are having to deal with all this, the firefighters, the people that have lost their homes. I think it's terrible. Over time, I think, there will be more, they'll rebuild. I don't think it really affects anything. Maybe it affects the California government in terms of budget, but
yeah. Steve, I read a thing the other day, didn't mean to cut in, but when they looked at the hurricanes in Florida, they looked at this, it's less than 1% of GDP. It's not going to move the needle. It'll move the needle if you were impacted. It will create a lot of uncertainty for people that worked, whether they were gardeners or whatever they did in those homes. But as you look at the US GDP, it's just simply not a needle mover. Yeah. Okay.
All right.
Well, with that, Bella, do you say the last few minutes or is it up to me?
I do. I have just a few more announcements just to end us off here. Let me share my screen here. Again, thank you to all of our presenters. I always feel like I learned so much listening on these two. So thank you so much for sharing your wisdom with us. And to all of you for joining us, we really do appreciate it. You'll be hearing from us once the recording is uploaded to our website and our YouTube channel. And you'll also be receiving an email pretty shortly here, probably, I'm hoping, early afternoon, with the survey. And we'd love your feedback. We put these webinars on for you. We want to make sure we're talking about topics that are relevant to you. And it also helps us prep more content like blogs and videos and social media posts. So if you have suggestions, we love to hear what you want us to talk about as well. If we didn't get to your question today, please send us an email to invest@kwbwealth.com and we'll make sure to get you an answer. So with that, thank you so much for joining and have a great day.
Bye-bye.
Thanks, everybody.